So, hello, my colleagues, and I do hope everyone is doing well. And what I want to talk about in this video for a while, financial contracts that fall under the heading of financial derivatives. And there are many, many different flavors of financial derivatives. What I want to talk about here, options, financial options, and the two in particular I want to discuss are call and put options. Now, financial derivatives basically are contracts that have an underlying asset, and it could be many, many different types of things. However, today I want to talk about financial options, calls and puts on stocks, where stocks are the underlying contract. So basically, we're going to talk about put and call options, and there should be a lot of stuff up on the blackboard on this. Okay, you should have a lot of content. If not, and we'll be going over this in class a lot. This will be part of MBA 502. All right. So, what is a call option? By definition, and a call option gives the owner the right to buy I'll put the word underlying asset. It says stock. That's very specific, but it could be an underlying asset. But it's the right to buy the stock from the person who wrote the option. Now remember, basically, it's a zero-sum game. For every buyer, there's got to be a seller. So if you're going to buy the contract, so you basically bought the contract, he's got to sell the contract. And there's a specific price called the strike price, and on or before the contract expires. Okay? So the first thing we have to know is if the owner is going to buy a contract, he's got to pay a premium. And he doesn't get that back. Okay, that's a one-time fee. You pay the premium, and the premium has two components called intrinsic and time value. And you basically will buy that contract, and normally the contract is for 100 shares size-wise of a particular stock. Okay, so it's for some particular stock. And the strike price is the price that a person would be able to exercise that underlying stock at. Okay, so basically the person who's selling, or the writer of this contract, and the right that goes with it, is writing the call. So here you see write, and here you see write. Okay. So if the party writing the call also owns the stock, he is said to be writing a covered call. Otherwise, he or she is writing a naked call. All right. Now let me explain something to you here. If you write a call and the buyer decides to buy the stock at that particular strike price, the writer has got to deliver that stock. If he's got it, he's covered. If you don't have it, he's naked, and he's got to buy it in the open market. Okay? So that's an important consideration. Okay? Now, why would someone write a call? Because if this guy here who's buying is paying a premium, then this guy who's writing is collecting a premium. And so that's the way that goes. And a single contract, as I said, is always for 100 shares of stock. All right. And I'll talk more about European versus American style options later on. All right. So now let's talk about. So that was a call. Let's talk about a put option. A put option gives the owner the right to sell the underlying stock to the option writer at the strike price on or before the expiration date. So it's basically just the opposite, so to speak, of a call option. So put and call options are financial assets called, and again here there's derivatives, financial derivatives, because their value depends upon the value of the underlying asset. So basically, you could say because their value is derived upon the value of the underlying asset, which by contract they are attached. In this case, the value of the underlying stock. Okay. So as I said, it doesn't have to be a stock. There's hundreds and hundreds of different types of derivatives. Okay, this is a general term, financial derivatives. All right, so here's a table that kind of shows you the option chain here. And this is a particular option for IBM. You see International Business Machines. Now this red box here is the stock information. Okay, so this is the stock info. You can see what it says here. This is not the option. This is what the stock itself. Here's the ticker symbol, and here's the bid and ask price. In case you don't know it, every stock has a bid and an ask price. Okay, so it's sometimes called bid and offer. Okay, so this is what the if you sold the stock, this is what you would get. And if you wanted to buy the stock, this is what you would pay. Notice there's you notice this is larger. You always pay more than you would sell it, and that's called the spread. That's called the stock spread. Okay. So here's the high and low, and here's the volume. I believe this might be the high and low for. Usually they give you the high and low for the year, and this may be the high and low for the year, I believe, because you can see there's quite a swing in price here. Okay. So now here's the options down here. See this red line? This red line separates the calls from the puts. Okay? And there's a bid and an ask for the contract again. And this is the premium you pay. And it says same as stocks. You see, it's a premium you pay. I'll talk more about in the money and out of the money and at the money at some other time. Okay? When we get further into it. But this is the bid and ask on the premium. Now, you notice the premium only says $29.40, but again, you got to multiply that by 100 because there's 100 shares. So the premium for this would be $2,940. So remember, so that stock has got to move now, and that call option has to basically perform enough to get you past the premium you're going to pay. All right, now here's the different strike prices for the call. You can buy it at different strike prices. And depending on how far in the money you go, the more you pay. So you see you're in the money here. Okay, so this is going to be high. And as you go down, the further down you go, you notice how it gets cheaper and cheaper. So here it's only, it basically goes down in price. And it's also a function of the expiration date too, okay? So they should give you the expiration date, and I don't quite see it here. They should tell you when it expires somewhere. Okay, so here is the different prices of the calls. Going up in $5 increments. Okay, so on the right hand side of this red line are the puts, and again their strike prices, which are the same as these strike prices, and the bid and the ask on the premium. Again, you would multiply that by 100. Okay, so all right, so here's the volume of contracts that are traded on any day. And this is the number of contracts that are open on total. So this is daily and this is total, and we'll go more and more into details on that at some other point in time when we get further into options and stuff. So suffice it to say, right now, this is the stock info that all these options are based on. Okay. So here's a blow up from the previous page. Again, here's the stock info. So you see what it says here. You can buy the IBM November 19th, okay, 195 call for $1.82 out of the money, which gives you the right to buy IBM for $195 per share. between November now and November 19th. Here's the $195 per share. Okay, I don't know how. I guess that date it was somewhere November 19th, 195. Let me scroll back a little here. I don't see dates, so all right. But anyway, change. All right, so here is the put option. Okay, so you can buy the IBM November 19th 175 put for $8.05 in the money. So you multiply that by 100, you multiply this by 100, which gives you the right to sell the IBM for 175 per share between now and November 19th. Okay, and we'll talk about things called protective puts, why you would want to get a protective put. So here's the bid ask. All right, the less the liquidity, the biggest the spreads. Liquidity means how much, contract size are being traded. Okay, so basically that's what's going on here. All right, so anyway, all right, so this is a graph that basically shows you potential call option values. Okay, upon expiration. All right, so let's look here. There's two curves. This is the gross value, and this is your profit loss. Now, what is the difference? The gross is your profit on the option itself, but the profit loss takes into account the premium you paid. So obviously, the blue line is going to be less than the red line because of the premium you paid. Okay. So what this is a bet, okay, based on this graph that the stock price is going to rise. So this is basically showing you what the option will be worth if held to expiration, given the possible prices of IBM. Okay, and you can see at your break-even point here. Okay, you start making a profit. Okay. And your break-even point is right here, okay? So you'll notice you've got a higher stock price is needed because of the premium here to break even, right? You're definitely in a hole here, and over here, you've got to basically you're trying to break even. So this is the underlying stock price, what you're seeing here as it's moving, and this is your profit loss or gross value. Okay. And likewise, there's a graph for the potential put values, the options, okay, on a put. And this is again a bet that the stock price will fall. And you can see you start making again, the same principle holds. You start making a profit when the stock starts going down past the strike price. So here's the stock price on the call, right? 177.62. And again, here's the stock price. So 177.62. All right, so that's it for now because this is almost 15 minutes in, and I will pick up with writing and being a writer, okay? All right, everybody. I hope I'm clear.